Hello everyone, my name is Anjani Kumar Khetan. I am based out of Bangalore. And in this particular video, we will conclude our deliberation on accounting for issued financial guarantee contracts, which we started a couple of weeks back. Now in this particular video, we will specifically cover two specific aspects. One is that when there is a financial guarantee which is issued within the group, how the beneficiary, like in the previous video we said, if holding company is issuing financial guarantee in favor of the subsidiary company, wherein bank has given loan to the subsidiary company, we have seen the accounting, what the issuer, the parent or the holding company does. But in this video, we will see how the accounting has to be done by the beneficiary on whose behalf the guarantee has been given. And also we will see that how the accounting for such issued financial guarantee contracts are accomplished in the consolidated financial statement of the group. Of course, we will also touch upon the accounting by the parent so that we have the holistic picture of all the parties involved, how they do the accounting. That means the parent, the beneficiary, and how that gets reflected in the consolidated financial statement of the group. So let's see this. I will try explaining this concept with the help of a case study. So we will first look at that how the beneficiary, is required to account for such financial guarantee contract in the separate financial statement. Then once we look at this accounting, then we will look at how in the parent's separate financial statement, such financial guarantee contracts are required to be recorded. This is exactly what we saw in the previous videos as well. This second slide would be just to give a continuation and a recap of what we discussed. And at the end, we will look at how in the consolidated financial statement, these issued financial guarantee contracts need to be accounted for. So let us first see how the accounting is done by the beneficiary. Let's see a case study similar to what we saw. I have just plotted those fact pattern here, that you have a ABSPL, which is a subsidiary. You have a parent, City Corp. B Bank has provided loan amounting to rupees 100 lakhs to the subsidiary. And this particular loan has been guaranteed by the parent City Corp. So the parent has provided guarantee to the B Bank, the provider of the loan, on behalf of the subsidiary, and no fees are charged by the parent to the subsidiary, though the fair value of the guarantee which has been given by the parent in this case is considered to be 2 lakh rupees, whereas the loan amount is 100 lakhs. And that's what, if you see on the left hand side, is being summarized here, that ABSPL, the subsidiary company, has applied for a loan of 100 lakhs from this particular B Bank. The loan requires guarantee of the parent City Corp, and therefore the parent has in fact given the guarantee. And by virtue of that guarantee, if the default is made by the subsidiary in making payment back to the bank who has given the loan, then in that case, the parent is required to compensate the bank for the losses that it incurs. And pursuant to that guarantee of the City Corp, loan was actually sanctioned by the bank to the subsidiary company ABSPL. As I mentioned, this case study assumes that no fee or premium is being charged by the parent to the subsidiary, and the fair value of such guarantee provided is considered in this case study to be 2 lakh rupees. Now the question is, in the separate financial statement of this subsidiary as well as of this parent, how this accounting has to happen. This piece we have seen in the previous video. But what we will focus first on this, and then I will just relate the accounting done by the subsidiary in the parent's book as well, and then we will look at what happens when it comes to the accounting of such contracts in the consolidated financial statement of the group. So the solution we will see in next few slides. We will first look at the accounting done by, or it is required to be done by, the subsidiary, the beneficiary. Now, when you look at the accounting for financial guarantee contracts by the beneficiary, there is one important question or a evaluation which one need to do. And this is what the evaluation which is required to be done. The key question which needs to be assessed is the guarantee which has been given by the parent, whether that guarantee forms an integral part of the loan which has been provided by the bank. Now the question is, what do you mean by that? So that answer, basically these two lines will give answer to what do you mean by the guarantee which is an integral part of the loan. Simply stated, what need to be evaluated is whether the guarantee which has been provided by the parent to the bank or the lender, whether that guarantee forms part of the overall terms and conditions of the loan. Thereby meaning that tomorrow, let us say the bank is assigning the loan to some third party. So if the loan were to be assigned by the lender banker to a third party, then whether the guarantee will also get transferred to the third party along with the loan. That is the moot question which one need to evaluate, because answer to this particular question will change the way in which the accounting is to be done by the beneficiary. Let us see what happens if the answer to this question is yes or no, as the case may be. First, let us see if the answer to this question is yes. What does it mean? It means that the guarantee which has been provided by the parent forms an integral part of the loan. It forms part and parcel of the terms and conditions of the loan. If the answer to this question is yes, then the recipient of the beneficiary of the financial guarantee will recognize the loan liability. In this our case, the loan was 100 lakh rupees at its fair value, including the value of the guarantee provided by the parent. Thereby meaning that there will be no separate accounting for the fair value of the guarantee given by the parent when it comes to the beneficiary's books. And therefore, the subsidiary is not required to recognize, because the guarantee is an integral part of the loan. The subsidiary is not going to recognize the value of the guarantee separately. Rather, that value of the guarantee will remain submerged in the fair value of the liability which they are recording. How it is, we will see just now the journal entry. And therefore the third point says the fair value of the guarantee given, in this case 2 lakh is the fair value of the guarantee given, that will remain submerged or included in the loan liability of 100 lakhs itself. There will be no separate accounting done by the beneficiary, provided the guarantee so provided by the parent forms an integral part of the loan. So if yes, what is the journal entry you will record? It's a simple normal journal entry. That means disregard the guarantee which has been given by the parent on behalf of the subsidiary. So the subsidiary would record simple entry, bank to the extent of cash which they have received 100 lakhs, and will create a loan liability of 100 lakhs which is payable to the bank. Now this answer in the accounting and the journal entry will change if the answer to this question is no. Let us see on the right hand side. So if the guarantee is not an integral part of the loan, thereby meaning that if tomorrow the loan were to be assigned by the lender to a third party, guarantee will not automatically go to the third party. So if answer to that question is no, then in that case the loan and the guarantee, they are two separate units of account. And therefore, if the answer to this question is no, then the financial guarantee provided by the parent is considered as a separate unit of account. What does it mean? It simply means that if you have a scenario where the guarantee is not an integral part of the loan, then the beneficiary, got to recognize by way of journal entry the fair value of the guarantee so given, which is 2 lakh rupees, they also need to record. So what will they do? So if the answer on the right hand side is no, then the subsidiary or the beneficiary will recognize the loan liability at fair value, but after excluding the fair value of the liability provided by the parent, which is 2 lakhs. That means out of 100 lakhs of the cash received, they will split the 100 lakhs. Credit will go to 98 lakhs as the loan liability, and 2 lakh is something which they need to record by way of capital contribution from the parent. Why this is capital contribution from the parent? Because this entry reflects the mirror image. If you recall the previous video, what did we say? In the previous video, we said that the issuer, the parent, will record the entry. What is the entry they will record? Debit investment in subsidiary to the extent of the fair value of the guarantee given, which is 2 lakhs in this case. Right? So the debit will go to the investment in subsidiary, and credit will go to the obligation towards the financial liability. That I will again put, in the next slide, I will put one more time that entry. But what we are saying is here that if the guarantee is not an integral part of the loan, then in that case, the subsidiary or the beneficiary is required to perform a mirror accounting of what the parent has recorded in its separate financial statement. And in the separate financial statement, parent would have recorded debit investment in the subsidiary. And therefore, the mirror image is they are recording as capital contribution from the parent. And therefore, the journal entry which you will record is debit bank 100, of course, the entire amount of loan which you have received by way of cash. But the loan liability gets credited only to the extent of 98 lakhs, because 2 lakhs, the fair value of the guarantee given, is recorded as a capital contribution from the parent. Moving forward. Now, this is the 2 set of entries. You remember these 2 entries? We will again come back to this when we relate to how the overall situation will unfold. Just remember this thing. If integral, then this is the simple entry. If not integral, then the entry is recorded, and wherein the credit also goes to the capital contribution, reflecting the mirror image of the accounting done by the parent in the separate financial statement. Now let's move further. Parent guarantor in the separate financial statement, I've already explained just in the previous slide as well. This is the entry which we saw even in the last session as well. The entry what the parent will record investment in subsidiary, debit to the extent of the fair value of the guarantee given, and the corresponding credit will go in the balance sheet to the obligation which has been assumed by way of giving such guarantee. This entry which we have seen, it is consistent with what we have discussed in the earlier video. Right? So therefore, this slide tells you that determination of whether the guarantee provided by the parent is integral to the loan or not, when it comes to the separate financial statement of the parent, they will continue to record this entry despite the fact whether the guarantee is integral or not. Now, the integral or not, that only differentiates and that determines the accounting by the beneficiary, not by the parent. And that's what it says. In the SFS of the parent, in the separate financial statement of the parent, the recognition of financial guarantee is irrespective of, is independent of whether the guarantee is a separate unit of account or not, thereby meaning whether or not that guarantee is something which is integral to the overall terms and conditions of the loan or not, that really does not determine the accounting when it comes to the issuer of the guarantee, the parent in our case. And therefore, if you look at the third point, irrespective of whether the guarantee is considered as a separate unit of account, the parent, the issuer of the guarantee, will always recognize the fair value of the guarantee in its SFS. And therefore, they will record this entry, which we saw in the previous session. Now, the question now comes, okay, we have seen the accounting in the separate financial statement of the parent, and in the previous slide, in the in the SFS of the beneficiary, the subsidiary. But what happens in the consolidated financial statement? Now let us see that next section in terms of how the accounting happens in the CFS. Now that accounting will be on the basis of whether the beneficiary has recorded the entry based on integral or non-integral. Let us see this, how this actually is being accomplished when we prepare the CFS. So therefore now we are looking at how the accounting is done in the CFS of the group, right? Let us see this. So in the CFS of the group, before we go into the slide, if you look at realistically from the group's perspective, what is happening from the group's perspective? From the group's perspective, the exposure which the group has is in reality is that the group as a whole has taken a bank loan of 100 lakhs. That's the economic reality of this particular transaction. And that is exactly what will get reflected in the CFS. Let's see this. So I brought forward the chart, what we saw in the previous slides, just for the sake of the completeness, and you will be able to relate. Now what happens in CFS? As I said, when it comes to the consolidated financial statement of the group, this is the economic reality. So in substance, in reality, from the group's perspective, group has actually incurred a financial liability to the extent of that 100 lakh rupees of the loan which they have taken. And therefore, CFS should include only that liability. Rest all are intra-group transactions that really need to be eliminated, right? So this liability of 100 lakhs will be measured by what we call as amortized cost basis. Again, this is something which is given in Ind AS 109 or IFRS 9, the equivalent literature in IFRS. Okay, so that is one. Now, irrespective of whether the guarantee is considered as a separate unit of account or not, the financial guarantee is not separately recognized in CFS, because in CFS that guarantee or the fair value of the guarantee, it needs to be eliminated. Now let us see how it impacts. Now depending upon whether the beneficiary, the subsidiary, this ABSPL in our case, whether they have recorded integral or non-integral, right? That in both circumstances, how the accounting entries are done in the CFS is what we will see. Let us see the first one. Now, consider a scenario wherein this subsidiary, ABSPL, the beneficiary, they have recorded financial guarantee as an integral to the loan. Then if you recall, what entry this guy has recorded? When it was integral, they record a simple entry. Bank 100 lakhs debit to the loan. But then in the SFS of the parent, they have recorded this entry, investment in subsidiary, to your financial guarantee obligation to the extent of the fair value of 2 lakh rupees. When it comes to CFS, this entry which was recorded by the parent in their separate financial statement, that will need to be reversed. And that's what the third point tells you here. So let me clear this. So in the CFS, the journal entry which was recorded by the parent in its separate financial statement now will be required to be reversed because it is intragroup, effectively speaking. And therefore, they will reverse this entry. What in the previous slide we saw, that entry gets reversed. Now, what is the effect of this entry? After this journal entry is recorded, what is left is the entry which this guy recorded, which means bank of 100 lakhs, credit liability, loan liability, 100 lakhs. That is the economic reality. And therefore, after this entry is recorded on the reversal, then the loan will be carried in the CFS at 100 lakhs, which is what it should have been recorded. But this is simple. But what happens if the subsidiary would have recorded this transaction as if the financial guarantee is non-integral? Now, if you recollect what we said, if non-integral, then the subsidiary would have recorded the entry wherein they will say bank 100 lakhs, credit loan liability of 98 lakhs, and then credit capital contribution of 2 lakhs. Right? So therefore, when the financial guarantee is considered non-integral by the subsidiary, then in this case, the subsidiary has accounted for the loan considering that the guarantee, if they have considered not an integral part of the guarantee to be an integral part of the loan, then in CFS, apart from reversing this entry, they will certainly reverse this entry even in this case also. But apart from this, they will record one more entry. What is that entry? Is this. Therefore, it says in the CFS, apart from reversal of the journal entry recorded by the parent, this entry. J, which is recorded by the subsidiary for recognizing the capital contribution of 2 lakhs, the credit of 2 lakhs, that also need to be reversed or it needs to be eliminated. And that elimination is done by transferring or reversing it to the loan liability. Now, in this case, originally the loan was recorded only 98 lakhs because the balance 2 lakhs was recorded to capital contribution. Now you reverse this 2 lakh and add it to the loan liability by recording this entry. So in CFS, when the financial guarantee was not considered as integral, second journal entry would be recorded wherein the debit capital contribution of the parent will eliminate the first entry of 2 lakh which you recorded in in case of SFS of the subsidiary company. That will get eliminated. And your loan liability, which was only 98, now gets restated back to 200. And that's what the economic reality is. And therefore, if you have this scenario, by the cumulative effect of these two journal entries, after this entry is recorded and the above entry is recorded, the loan will be now again carried in the CFS at 100 lakhs and this guy will get eliminated. So this is the economic reality of the group. And that's how you do the accounting in CFS. This is exactly what I wanted to cover in this video. I hope you liked this entire series of videos related to accounting for the issued financial guarantee. 3 videos in that series. I hope you would have liked it. Here are my coordinates given for the social media. Please like and subscribe the channel so that I remain completely motivated to produce these kind of videos. And also, if you subscribe, you will not miss out on any future videos which I will be uploading. Okay. Thank you very much, and we will see you in the next video. Thank you. Bye for now.